Okay, good afternoon, everyone. Welcome back to our options education webinar series. I hope everyone's doing well this afternoon. Today, we're here to talk about how to get started with options trading. This webinar is really for those of you that are relatively new to options trading. So before I get started, I just want to say trading options is something that takes time to learn. It's certainly something that you can't expect to master in a few days or a few weeks or by watching a single webinar. It's something that takes a lot of time to really get the concepts and get comfortable enough with trading. Many times I hear from a lot of users that it takes them really 3-4 months to get comfortable after going through the learning process, uh, taking some steps to research the topics and go through some practice trades before they feel comfortable enough to start trading their first live trade. So today, what we're going to do is we're going to start with the basics, make sure that everyone understands the two basic strategies that you would typically start with as an options trader, understand what are the best practices for those strategies and starting points, and make sure that make sure that we go over some of the common mistakes that beginners make to hopefully help everyone avoid some of those beginner mistakes for those of you that are starting out. So today, not only do we want to go over the strategies and how to go about doing them, but more importantly, actually making sure that you guys understand what tools are available to you so that you can utilize and implement the strategies that we're going to show you here today. I want to make sure that we explore the two different option strategies for speculating and for income so you understand the scope of how options can be utilized for your portfolio. Like I said, this webinar is really geared for those of you that are relatively newer to options trading. However, if you're already trading options, I really hope that some of the basic concepts here or the basic topics provide you with a different light as to how you actually think about options for your portfolio and think about the different ways that you can utilize them and open the possibility of different options that you may not have considered for your portfolio. So my name is Tony Zhang. I'm the chief strategist here at Options Play. We're here to do bi-weekly webinars for everyone so that you guys have an ongoing education for various option strategies from beginner topics to more advanced topics. And like I said, most importantly, we want to make sure that you guys have access to the right tools, not just the education, but the tools afterwards so that you can implement what we're teaching you here today. And that's really where Options Play comes into play. And we'll show you how to access Options Play for those of you that are brand new. It's a free resource available to everyone, including these bi-weekly webinars, really designed to provide you with as much content as possible, and then utilizing the tools so that you can actually implement them on your portfolio. So today, I'm going to spend about 15-20 minutes on the slides. This whole webinar is recorded, and the slides will be made available to you afterwards along with the recording. About 30 minutes afterwards, we'll send you the recording. So for those of you that are brand new and you need to take some more time to go through things slowly, you can view the recording with your slides at your own pace. So let's go ahead and get started here. Today, just a quick disclaimer before we get started. What I'm going to talk about here today is only for educational purposes. It is not a solicitation or recommendation to trade any specific securities. So before I jump into the actual topic, I just want to make sure everyone understands you guys all have access in Canada to the free platform Options Play Canada. This includes bi-weekly options education webinars, free on-demand options video library for all the previously recorded webinars so that you can learn more about other option strategies if you want to learn more about it. And we also send out weekly cover call and short put reports, which we will cover one of these strategies in today's webinar. And for those of you that have not signed up, please register using this link I just sent to everyone in the chat window. If you have not registered for Options Play, I highly recommend you to do that so that you can continuously access these ongoing education webinars and the platform that we're going to show you here today. Now, just by a quick show of hands using the chat window, if you guys can just pull up your chat window. If you're brand new to options trading, please type yes into the chat window. If you have traded options before, please type no. I just want to get a quick sense of the audience here in the room. So again, yes, if you're brand new, no, if you have some trading experience trading options. Okay, I think I have a pretty healthy mixture here of yeses and nos. So for those of you, again, that are yes, meaning you're new to options trading, this is really designed to help whet your appetite and show you the power of options and give you a sense for what are the different ways you can utilize options. And for those of you that have traded options before, I hope you're able to learn something about the way that we teach options from the perspective of how you should consider options as a tool for your portfolio. So today what I'll do is I'll go over a couple of things. Number one, I want to talk about understanding the difference between trading stocks versus trading options, because that's really the first part that every options trader needs to understand is the fundamental difference between these two strategies. Then I will dive into the two basic strategies we're going to cover, which is buying calls and puts for speculating on a bullish or bearish view for a stock, and then selling cover calls, which is the basis of all income strategies utilizing options. And those are the two primary uses of options, is to speculate, meaning you have a bullish or bearish view on the markets and you want to express that. Buying calls and puts allows you to do that, but it's really important to understand what those call and put contracts mean and how you can actually profit from them. And the second main use of options is to generate income, and cover calls is the first strategy to learn about when you're trying to generate income utilizing options. So we're going to cover those two strategies. And in order to understand how the option strategies perform as the stock markets move up and down, it's really important to understand the Greeks. So I'm going to go over two of the most important Greeks that you need to understand, and then we'll cover common mistakes, hopefully help for those of you that are starting out to avoid those common mistakes. And lastly, we're going to go over to options play. I'm going to show you some strategies using the platform so that not only do you learn these strategies from a conceptual perspective, you actually have the tools to implement them so that you become self-sufficient in being able to explore these strategies and start analyzing them for yourself on the individual stocks or ETFs that you want to utilize options for. So let's go ahead and get started. First, I want to talk about the difference between trading stocks and options. So when you're stock trading, the good thing about stock trading from my perspective is that it's pretty simple. Pretty simple to understand. However, it's fairly limited in scope in terms of what you can do with the stock, with trading stocks. And the reason I say this is because when you're trading stocks, you only get one type of exposure, and that's to direction. Meaning, you either think a stock is going to go up or you think the stock's going to go down. So it's really simple to understand, really simple to do, because if you think the stock's going to go up, you go long the stock or buy the stock. If you believe the stock's going to move lower, you can short the stock and you can expect the stock to move lower. So those are the two options that you have, if you will, no pun intended. When you're trading stocks, it's fairly simple, really easy to understand. I'll go through a visual example of this in the next slide for those of you that want a little bit more information on stock trading. But I think for most people, that is pretty straightforward as far as buying and selling stocks because you think it's going to go higher or lower. When you're trading options, this is where you get a little bit more complex. But what that complexity, what that gives you is what we call a lot of flexibility, meaning you're going to have a lot more options and you can use this for lots of different things. Because when you're trading stocks, you only have a directional exposure. When you're trading options, you have three different types of exposure. You have direction, you have magnitude, and you have timing. So direction is just like stocks. You either think a stock or ETF is going to go higher or lower. A magnitude, meaning whether you think the stock's going to go higher by 1% or 10%. You have different levels of exposure. And lastly, timing. Because when you trade a stock, it doesn't matter whether you hold on to that stock for a day or a year. If it goes up 10%, you make 10%, regardless of how much time it takes. With options, there's a timing component built into it. So you have a lot more complexity, which at the end gives you a lot more flexibility as a result of that. So with the stock, you can go long the stock, you can short the stock. When you're buying an option, you can buy or sell the option just like a stock, but you have the choices of either buying a call or a put, or you can sell a call or you can sell a put. And sometimes that can be a little confusing. And I'm going to go over the different combinations and what each one means. And I have a really easy way to help you remember what buying a call or selling a call or buying a put or selling a put means. So you can choose your direction by buying or selling either a call or a put. You can choose the magnitude as far as whether you think a stock's going to move 1% or 10% by choosing different strike prices. And lastly, based on timing, you can choose different expiration dates. So as you can see right off the bat, you have 1, 2, 3, 4 things to consider as opposed to only 1 and 2 things that you need to consider when you're buying that stock. So as you can see immediately when you're trading options, this is the complexity piece that I think most people take a little bit more time to really learn and get familiar with, is the fact there's a few more things that you have to consider when you're trading options that you don't have to consider when you're trading stocks. So today what we're going to do is we're going to spend a little time, understand the nuances of all of these different parameters, what they mean, and then show you what are the best practices for each one for different forms of trading. So to start off, let's talk about the 2 strategies we're going to go over here today. We're going to talk about generating income, and then we're going to talk about speculation. So generating income is the first and foremost strategy that you're going to be able to do in your options trading account. It's the first strategy that you're approved for. Because when you're trading options, you actually have different levels of approval. Your broker will, depending on your trading experience, approve you for different levels of trading options. And the first level you get approved for is the sell covered calls. And the reason that this is the strategy that you get approved for first is because this strategy doesn't add additional risk to your portfolio. Pretty much all other strategies will add additional risk. So a cover call is essentially selling a call option against the stock portfolio that you already have in your portfolio. So any of you that trade stocks today, you can sell a call option against the stocks that you own to generate some income. You can think of it almost like creating a dividend yield on the stocks in your portfolio. I do have a whole separate webinar just on selling cover calls. So for those of you that are interested in learning more about this strategy, I highly recommend you to take a look at the options video library that will help you learn more about the strategy. But this is a strategy that requires at least 100 shares of stock in your account. And the basis of this strategy is to sell relatively short dated options, so about 1 month out, and you want to sell out of the money calls. And if you don't know what that means, we're going to review this and we're going to go into more detail in the next few slides as to what selling an out of the money call refers to. Now, that's the simplest strategy that you'll be approved for when you first apply for an options trading account. The second use case of options is to speculate. And this is I would say, the strategy that most equity or stock investors are familiar with, because when you trade stocks, you're effectively speculating because you either think the stock's going to move higher or lower, and this is where you can buy a call or a put option to do the same type of speculation. Now, buying a call or a put is definitely going to be very different from buying or shorting a stock, but it allows you to profit from the stock moving higher when you buy a call. That's a bullish strategy that will provide you with a bullish exposure with limited risk. And then buying a put option is a bearish strategy that gives you bearish exposure, also with limited risk. And I think the key here with those of you that are first learning about options trading is that when you buy a call or a put, you have what's called limited risk, which means that no matter what happens, the most you can risk is what you pay for that call and put. So you can determine how much you're willing to purchase, and no matter what happens, you cannot lose more than that. And that's one of the great things about trading options, is that you do have some strategies that are not, or the strategies that we're going to go over here today all have limited risk. So I get a lot of questions from users sometimes concerned about the risk of trading options. And I want to make sure that all the strategies that we're going to go over here today have limited risk. And the starting point for when you're buying options is a little different than when you're selling options, is you generally want to go a little further out in time. You usually want to start about 1 to 2 months out in time is usually a good starting point. And then when you're buying calls and puts, this is when you want to buy in the money strikes. So we're going to go over what that means and with some concrete examples as to what in the money and out of the money options mean. So before I jump over that, I just want to clarify a few things for users, because of the fact that you can buy and sell, call and put, sometimes that's a little confusing. So what we're going to talk about, number one, is just a quick way to decipher or demystify, what the different strategies are. And for that, what we're going to do is we're going to use basic multiplication. So basically, what you learn in elementary school, what we're going to do is buy is going to be a positive sign, sell is going to be a negative sign. I think that's pretty self-explanatory. And a call will be a positive sign, and a put will be a negative sign. And what we're going to do is we're just going to do basic multiplication to understand whether a strategy is bullish or bearish. Anything is positive is bullish, anything is bearish, negative is bearish. So when we buy a call, we have a positive multiplied by a positive, which gives us a positive. So buying a call is a bullish strategy. On the flip side, selling a call, which is a negative multiplied by a positive, is a negative. So selling a call here is bearish. Buying a put, because you're doing a positive multiplied by a negative, is also a negative. So buying a put is bearish. And lastly, selling a put, which is negative multiplied negative, gives you a positive, and that's bullish. So this is an easy way to remember what all the different combinations mean in terms of whether you have a bullish or bearish position. So today, what we're going to do is we're going to talk about buying a call, which is bullish. We're going to talk about buying a put, which is, buying a put, buying a put, which is here, which is bearish. And lastly, we're going to talk about selling a covered call, which is also bearish. So those are the three strategies we're really going to cover here today. We're not going to cover selling a put, but those are the strategies we're going to cover here today because those are the basic strategies. So first, what I want to do before I jump into option strategies is to give you the stock comparison. So here I have a chart of BMO stock. BMO, and I'm using BMO because it happens to be a stock that's trading right around 100. And I like to use round numbers for illustrative purposes when we're doing education. So BMO is trading at just shy of $100. So if you're bullish on the stock, what would you do as a stock trader? You'd buy the stock. If you're bearish on it, you short sell the stock. Those are your two options. And what's easy to understand about stock trading is that you have immediate gains if the direction that you call is correct. Meaning, if you buy the stock and the stock goes up by a penny, you start making money. If the stock goes down by a penny, you start losing money. And vice versa, if you're short, just the exact opposite. And what I think for most people is easy to understand about stock trading is that you get symmetrical exposure. What that means is that you get dollar for dollar. If the stock moves up by $1, you make $1. If the stock goes down by $1, you lose $1. Really easy to understand. There's any time horizon, meaning you can hold on to that stock for a minute or a day or a year. There's no limitations there. However, there is a major limitation on stocks from the perspective of there are no neutral options. What that means is that if I felt that BMO is just going to stay around $100 for the next month or so, maybe interest rates are not really moving, I don't expect a big move in the markets, and I think the stock's just going to stay there, there's nothing I can really do as a stock trader. I don't have any options if I feel the stock's going to be in more of a neutral range. So if you think the stock's going to trade sideways, there's no stock trade that you can do to express that view and make money from the stock not moving. However, on the option side, there's a lot more options, pun intended, if you will. So first, let's talk about speculation. Let's talk about buying a call option. This is a simple strategy. This is probably one of the first strategies that you'll learn as an options trader is buying a call option is bullish. However, one of the biggest differences between buying a stock and buying a call option is that when you buy a stock, the second the stock moves up even by a penny, you're going to make money. When you buy a call option, that's not the same. When you buy a call option, you will only profit if the direction and magnitude moves higher by more than the premium that you've paid for that call option. So what that means is that you have to pay a certain amount of money to buy that call option. And that amount of money that you pay, the stock needs to move by that amount in order for your strategy to be profitable. Now, the risk that you have on this particular case is limited to what you've paid for that call option. And I have an example in the next slide for you with some concrete numbers, and you maintain exposure until the actual expiration date. So unlike a stock where you can buy and hang on to it for a year, when you buy a call option, you have to have an expiration date, and the trade is only good until that expiration date. So an example of this is, let's say I'm looking at BMO, which is trading around $100. So let's say I buy a 2-month 100 strike call option. So a call option that has a strike price as the current price. And let's say I have to pay $2 for that call option. So unlike the stock, where the stock, if it goes up by a penny, I start making money, here, this BMO stock has to move all the way up to 102 at expiration in order for me just to break even, which means that I have to believe BMO is going to move at least above 102 in the next 2 months in order for my strategy to be profitable. However, when I buy BMO stock at $100, I'm risking $100 a share. Because this call option only cost me $2, I'm only risking $2. So even though the stock needs to move more in order for me to be profitable, if I'm wrong on this trade, the most I lose is $2. So when I buy a 2-month call at $2, let's say this call cost me $2, this strategy is only profitable if BMO is above 102 at expiration. And the reason I arrive at 102 is the $100 strike price plus the $2 I pay gives me the 102 break even. And the max risk that I have here is only $2 a share. So instead of risking $100 a share, I'm only risking $2 a share. And the trade-off that I have with this is the fact that the stock needs to move $2 before the strategy is profitable, unlike a stock trade where the stock can move even by a penny and I'll be profitable. And one of the good things about this strategy is the fact that you have unlimited gains above 102. So if you think the stock's going to move to 110 between now and 2 months from now, you have unlimited gains. So you can make $8 to the upside while risking $2 if the stock does rise to 110. And you maintain exposure only until expiration. So this trade is good for 2 months. So I'm only maintaining exposure in BMO over the next 2 months. If the stock moves to 130 5 months from now, I don't participate in that because I only have a 2-month option. So this is really one of the illustrative ways to show you kind of what trading a option or a call option looks like. Vice versa, if I was to buy a put on BMO, same thing. Unlike when I short a stock, the stock needs to move significantly. The stock only needs to move 1 penny in order for me to be profitable. When I buy a put, it's only profitable if the direction and magnitude moves lower by the premium that I paid for the put option. So just like the call option, a put option will cost me money, and the stock needs to move by that amount in order for me to be profitable. However, the trade-off that I get with that is that I have limited risk. And this is an extremely useful tool if you have a bearish view on a trade, because when you short a stock, you truly have unlimited risk. If you short a stock and the stock moves to 110, 120, 130, the more it moves against you, the more money you lose. When you buy a put option, the put that you pay, let's say you pay $2 or $3, that's the most you can lose no matter what happens. And that's really one of the things that I think, in my opinion, if you have a bearish view on a stock, you should certainly consider buying a put as opposed to shorting that stock. So a numerical example of this is simply the same thing. Let's say I buy a 2-month put option on BMO. Let's say that put option cost me $2. Now the strategy is profitable as long as BMO is below $98 because I have a 100 strike put. I paid $2 for it. So the stock needs to move all the way down from the 100 down to 98 before the strategy is profitable. And this, again, the trade-off that I have here, because the stock needs to move $2 before the strategy is profitable, now I only risk $2 a share. Unlike shorting a stock where I have unlimited risk, now I'm limited to only $2 a share. And that significantly reduces my risk. And I still maintain unlimited gains below 98. So if the stock goes all the way down to 0, I make $98 a share while only risking $2 a share. And just like the call option, I maintain exposure only until expiration. So only for the 2 months do I have bearish exposure to BMO. Anything beyond that, I do not participate in that. So those are the 2 scenarios that you'll come across with buying a call and buying a put to speculate on a bullish or bearish view on an underlying stock. Next, what I want to explore is really selling a cover call. This is an income generating strategy. So many other strategies that you'll learn as you learn more about options trading are going to be based on income generation. And one of the best ways to learn about how to generate income using options is to sell cover calls on the stocks that you own in your account. So here I have, pretend I already own BMO stock. So Pretend you already own BMO stock, and you can replace BMO with any other stock that you currently hold in your portfolio. This strategy allows you to collect income if the stock closes below the strike price at expiration. So think of the strike price as a barrier where you just want the stock to stay below that price. And as long as it stays below that price, you're going to be able to collect income. In the event that the stock rises above that strike price, that's when you effectively take profit on your stock. So you can think of the level that you sell a covered call on as almost a take profit level. So let's say I own BMO stock at 100. Maybe I have a target price of 102 or 105 or whatever your target price is. You can sell a cover call at that price, collect some income. If the stock doesn't exceed that price by expiration date, you keep the income and you do it again. If it exceeds that level, you effectively sell your stock at that level and take profit on your stock, or sell your stock at a profit. So you can basically rinse and repeat this for consistent income until you sell your stock at a profit. And that's really, in my opinion, the best way to think about cover calls is to put in an order to sell your stock at a higher price, collect some income to do so. If it doesn't reach that price, you can sell another cover call, and that can create your income stream. If the stock does rise to 102, now you've taken profit on your stock and you've collected some income. So this is really the different ways that you can utilize options to generate income. So here in the example, let's say I own BMO stock. Let's say I bought the stock at $90 a few months ago, and I have a target price of the stock currently at 102. So what I do is I sell a 1 month 102 strike cover call. Let's say I collect $2 for that call, and now I have two potential outcomes. So in a month's time, either the stock is above 102 or it's below 102. If the stock is below 102, then I collect the $2 income that I received from selling that cover call, and I get to do it all over again next month. If the stock is above 102, then I take profit on the stock at 102. So now I own the stock at 190, I sell the stock at 102, I make a $12 profit on the stock, I make a $2 profit on the cover call, so I make a total profit of $14 on this trade. Normally, if you put in a limit order to sell at 102, you just make the $12 difference between the 102 and the 90. Here, by selling a cover call, I make that difference, which is $12, plus the $2 that I get on income. And that's really the benefit of selling cover calls, is the fact that you can basically put in a limit order to sell your stock at a higher price, but get paid to place that limit order. And that really generates a consistent income stream in the long run for your portfolio if you do this across all the stocks in your portfolio. So if you want to learn more about selling cover calls, we have a video specifically just on that. So those are the two primary strategies that you would utilize options for. And in order to really understand how your options trade is affected by moves in the underlying stock, we need to observe two Greeks. And this is really where we start to get into a little bit of math. However, I'm only teaching you this based on a conceptual level. You don't have to actually do the math yourself, because tools like Options Play will calculate these for you and show you the end result. But I really want to make sure people understand these two concepts and understand that they exist out there so that you can utilize them in your trading down the line. But right now, this is just for you to understand from a conceptual perspective. So when you buy that call option, so let me just go back to this example here, where if we buy a 2-month $100 call for $2, and let's say I have a bullish view on BMO. Let's say I think the stock's going to go up to 105. If I bought the stock, I know that if it goes from 100 to 105, I'll make $5 a share. But if I buy a call option and the stock goes from 100 to 105, how much money do I make? And the answer to that question is answered by delta. So the delta of a call option tells you exactly how much money you'd make based on a different change, based on the change in the stock price. So if a call option has a delta of 0.5, that means for every dollar the stock moves up, the option will move up by half as much. So 50 cents for every $1 move in the stock. So if I think the stock's going to move up by $5, I roughly see about a $2.50 change in the option price. So what that means is my $2 option will increase to about $4.50 because it'll move roughly $2.50 in my favor on top of the $2 that I pay. So that's how you can get a rough estimate as to how much money you make on that call option. Now, the second concept that you need to understand is that options values will decrease as time goes on because an option contract will expire at some point. So the longer you have, the more uncertainty you have between now and expiration, and that uncertainty is expressed in the price of the option. And as you get closer and closer to expiration, that uncertainty factor goes smaller and smaller because if expiration's tomorrow, I have a fair amount of certainty that the stock's not going to move $50 tomorrow. So the price of an option will actually decay as you get closer to expiration. And it's important to understand how much the option will decay. And Theta tells you that. It's the change in the option price with respect to time. So Theta tells you how much it loses per day. So if you hold on to an option for 10 days, Theta will tell you roughly how much that option will decay in price. And this is really an important concept to understand because a stock trade, you can hang on to it for as long as you want, and a stock value will not decay with time, but an option will. So it's really important concept to understand because that decay will work in your favor when you're selling an option, such as a cover call, because when you sell an option, you want the value of that option to erode all the way to zero. And if you're able to do that, you collect all the income. If you're buying an option, such as in a call or a put, that erosion works against you. So this is really why we move on to the next slide to talk about what are the common mistakes users make. So when you're buying options for speculation, so if you have a bullish or bearish view and you're buying calls or puts, one of the beginner mistakes that most people make is that they'll buy a 1 month or 2 month option and they'll hold on to that trade until expiration. And you never want to do that when you're buying an option. When you're buying an option, you generally want to exit before the actual expiration date. So if you bought a call option, you want to sell it before the expiration date. You don't want to hold on to expiration because of this theta, because of this time decay that we're talking about. You don't want to hang on to it because the option value will decay. So the longer you hold on to it, the more that decay works against you when you're long the call option. The second mistake that most beginners make when they're buying an option is they use expirations that are too short. And that's usually when you're using expirations that are 1, 2 weeks out because you're not giving yourself enough time for the stock to move in the direction that you expect it to. So chances are you may not get the move that you expected to. So you usually want to buy an option that's a little further out in time. And I don't have enough time to get into the nuances right now of buying a call and put and how your option is affected based on a few different factors. But we do cover this in depth in some of the other webinars that we do. So this is really, again, a webinar designed to kind of whet your appetite and understand what are the different use cases of options. If you really want to explore more about the best practices of each one, again, please view some of our previous recordings on these specific topics. So when you're buying an option, you don't want to use expirations that are too short. Again, you want to use expirations that are at least 1 to 2 months out, give yourself enough time so that if you expect a move to happen in 3-4 weeks, it might end up taking 5-6 weeks. You want to give yourself a little buffer on that time zone when you're buying an option. Vice versa, when you're selling an option for income, such as selling covered calls, one of the first common mistakes that we typically see with covered call sellers is they sell calls that are too close to the current price of the stock. And what this does is it limits the upside of the stock that you hold. And you hold on to that stock because you think it's going to increase in value. You don't want to just cap the potential returns of that underlying stock. So if you're selling covered calls, you generally want to sell covered calls that are relatively far away from the current price. Now, when you're selling covered calls, a common mistake that we typically see is that users, unlike buying options, they do the opposite. They sell expirations that are too long. And there's a natural reason for this because the further out in time, the more income you receive. And a lot of beginner covered call sellers will say, oh, I want to go out, I want to receive more income, so I'm going to sell a 3-month call instead of 1-month call. But this is a fallacy in selling options because you can make more money selling 1-month calls 3 times than you can make selling a single 3-month call. So when you're selling covered calls, you want to focus on shorter end shorter dated options, so usually less than 1 month out is a suitable starting point. You just want to do that as frequently as possible, even though you're getting less income on a shorter dated option. But in the long run, you'll make more money selling short dated options more frequently. And lastly, when you sell options, you generally want to avoid doing so going into earnings. So if you have earnings coming up, not a good time to sell any type of option strategies, whether you're selling covered calls or for those of you that have more experience trading other strategies, selling covered calls is not something you want to do, or any option strategy during earnings. So those are the common mistakes that people make when they're buying or selling options. So with that, what I want to do is I want to jump over to Options Play. I want to give you a quick walkthrough of the platform and show you how our platform is actually designed to give you starting points for both of these two strategies, so that as a beginner, even if you don't know a lot about options, you have some tools to help you get started to picking expiration dates and strike prices. So I mentioned a lot of different best practices here on the slides, but our tool actually does that work for you, so that it gives you starting points based on those best practices. So even if you're not familiar with choosing expiration dates and strike prices, and you're just barely following what we're talking about here today, our platform will actually do that work for you. So, and one of the reasons we created this platform is because many of you that trade options, you've seen pages that look like this. If you currently trade off of a page that looks like this, please type yes into the chat window. And if this is a page that sometimes confuses you as you start out, please type yes again as well into the chat window, just so I get a sense for the users that are here in this room. Because, this page, when we started out building Options Play, we really found that this page was a barrier for a lot of people who are starting out, because they found that this page not only was confusing, they didn't know what expiration dates to choose, they didn't know what strike prices to choose. There's a lot of different things that you have to work on to get to a starting point. And even if you knew exactly where to start, even if you were a professional like us, chances are when we use pages like this, we still had to do a lot of back of the envelope estimations in our head, just to get a sense for, okay, I think the stock's going to go up by 5%. How much money do I make, or how much money do I risk? Those are not easy calculations to make on the fly when you're trying to make split-second decisions. And that's just really why we created Options Play, is because not only did we want to give you a better user experience, we wanted to give you starting points based on best practices, and we wanted to give you the analytics that you needed to actually decide which one to trade. So this platform, like I said, for those of you that don't have access to it already, I'll send you a link at the end to how to register for this platform for free. This is designed from the ground up to make your life with options trading, regardless of whether you're a beginner or an experienced trader, as easy as possible. It's divided into 3 sections. You have trade ideas and watch lists on the left-hand side. The middle panel is their security analysis panel. And lastly, trading and income here is on the right-hand side. We call these 3 panels the what, the why, and the how of options trading, because when you log in every single day, you're interested in understanding what symbols should I pay attention to. So we have trade ideas that are scanned, fresh, bullish, and bearish ideas for you every morning. You have a watch list functionality that allows you to look at the watch list these are pre-built watch lists, including watch lists that we have already built for you. You can create your own watch list as well. The middle panel is our security analysis panel. This gives you snapshot technical analysis data so that you can quickly see 1 month and 6 month trend of the stock. So for BMO here, it's 1 month and 6 month trends are bearish. You can actually see how that trend quality has changed over time. As you can see, that trend really started to deteriorate here in early May, and started getting turned bullish into neutral and started to turn bearish here in late May, and it started to continue to deteriorate. So here for BMO, from this perspective, the fact that it's got a neutral relative strength and the 1 month and 6 month trend is bearish, I have more of a bearish tilt on this specific name. We have important information such as earnings, dividends, and price action data here at the bottom. And this really allows you to quickly type in any name and drive a quick sentiment as to whether you're bearish on the stock or bullish on the stock. So let's say I'm bullish on BMO. It's trading at roughly $100 right now. When I click on I'm bullish, we'll present to you 3 bullish strategies on the trading tab. And these strategies represent stock trading, which is nothing to do with options, a call option, which is a simple option strategy that we just discussed here today. So for those of you that are brand new, you're typically comparing buying the stock to buying a call option. And for those of you that are a bit more advanced, buying this call spread here on the right-hand side. I'm not even going to go into the call spread just yet today. We have a whole separate webinar just on that alone. So today we're just going to talk about buying the stock to buying a call option. So if I'm bullish on the stock, I'd have to cough up roughly $10,000 to buy 100 shares of BMO. Buying a call option, buying a July 19th, which is which expires in about 45 days or so, a 99 strike call, which is the at the money strike or just slightly in the money, cost me $234. So remember, when you buy a call option, the most you risk is what you pay. So when you buy $10,000 worth of stock, you're risking $10,000. When you buy a call option, you're risking $234. So BMO is trading at $100. Even though I'm not bullish on this stock, looking at this chart, if the stock was to move higher, I'd expect it to make a move to about 103, maybe 104, back to the range that it was trading at just a few days ago. So we have a P&L simulator. This allows you to compare a stock to a call option to say, if I think the stock's going to go up to 103 by the July 19th expiration date, well, if I had bought the stock here, I make a 3.5% return. If I bought the call option here, I make a 70% return. This starts to allow you to have a starting point without having to use a page like this to figure out where your starting point is. You can figure it out by going through pages like this, finding the 45-day option, finding the at the money call, seeing that it's trading at 232, like as you can see here, and then having to do some mental math in your head to say, if I think the stock's going to go to 103, how much money do I make? Here, not only do we provide a starting point for you, we also show you the calculations for if the stock goes up to 103, how much money do you make? And vice versa, if let's say, in my opinion, since I do think the stock's going to pull back, let's say it pulls back to 97.5, how much money do I actually lose? If I bought the stock, I lose $201. If I bought the put option, I lose $234. So this allows me to utilize this tool to actually see, well, if the stock pulls back to 95, I lose more and more money if I had bought the stock. But if the stock moves down, no matter how low, the most I can lose is only $234. So my losses are capped at $234, but if the stock moves higher and higher, my gains, as you can see, are magnified by the fact that I only have to pay $234 to buy this call versus $10,000 to buy the stock. And this gives me the leverage that I want when I'm buying that call option. Conversely, if I'm bearish, let's say I'm bearish on BMO, so trading at about $100, so easily I would expect the stock to move down to about 97.5, which is where it was trading at just a few days ago. So let's say I think it'll go to 97.5 conservatively. If I shorted the stock, I'd make a 2% return. If I bought the put option, which here is the July 19th 100 put, it'll make $21. And notice how this platform does all of this work for me of selecting an expiration date, selecting a strike price, and gives me the starting points that I need. So instead of having to pull up an option chain, selecting an expiration date and strike price, it does the work for me. I just have to type in a symbol. So let's say I'm looking at weed, canopy growth. Let's say you have a bullish view on canopy growth. It just broke above that $57 support resistance level. Let's say I'm bullish on this specific stock. I could buy 100 shares of the stock for $5,700, or I can buy a call option for $470. This allows me to quickly type in a target price. Let's say I have a target price of $65 on the stock. If I bought the stock, I'd make a 13% return. If I bought the call option, a 91% return. So I can quickly see, okay, if I'm right, how much money do I make? But I think more importantly, for a lot of options traders, they want to understand your risk. So what happens if the stock pulls back to 51? As you can see, if I bought the stock, I'd lose $615. If I bought the call option, I lose only $470. So this tool not only allows you to see your potential rewards, but more importantly, really allows you to understand your risks so that you know what your risks are before you get into a trade. And that's one of the most important things for most users. And once you've honed in on a trade that you'd like to make, clicking on the trade button allows you to find out how to enter this trade into your broker's platform. So regardless of who you trade with, you can utilize this to quickly enter this into your broker's platform for execution. And lastly, before I leave, I just want to show you guys, for those of you that are interested in selling covered calls, because again, that's the first strategy that you're typically approved for when you're selling, when you're applying for an options account. You can click on the income tab. The income tab will provide you with a covered call idea and a short put idea. Today, we're just going to talk about covered calls, and it will ask you, do you own shares of weed? Because to sell covered calls, you have to own the stock. You would answer yes. You can type in the number of shares that you own, and it will spit out a starting point for a covered call. So we talked about in the slides that when you sell covered calls, you want to sell with roughly a 1 month out of the money call option when you're selling covered calls. So Options Play will actually apply this for you automatically. So it'll sell the July 19th, which is roughly about a month away. It'll sell the 66 calls, which are all the way up here. So basically the stock needs to rally all the way up to $66 in the next 38 days before the stock is called away. And you collect $210 in income, which comes out to be a yield of about 17% on a stock that pays 0 dividends. So if you own Canopy Growth, you get paid $0. You can increase your yield by about 17% by collecting $210 on your 200 shares in the next 38 days. And you can use this to type in any stock. So let's say you own BMO stock now. This is telling you to sell the July 19th 103 covered calls. This will collect $51 in income for every 100 shares that you own, which annualizes out to a 4.92% yield on a stock that already pays you a hefty 4% dividend. So that increases your total yield from 4% to about 9% by adding covered calls to it. And this is really a tool that's designed to make your process of finding your starting point as easy as possible and help you avoid pages like this that ends up many times confusing most people more than anything else. So what this allows you to do is, again, type in any stock. So let's say you own I meant Bank of Nova Scotia. Regardless of what stock that you own, if you're looking to generate income, you click on the income tab, and this tool provides you with starting points for an expiration date and strike price and gives you the details to understand how much income you're actually going to receive. And for those of you that are trying to trade this market, meaning if you have a specific directional view, let's say you're bullish on TELUS and you think the stock's going to continue moving higher, you can use this to compare buying the stock to buying a call option, and it gives you the starting points for both expiration dates and strike prices, regardless of whether you're bullish on the stock or bearish on the stock. And you can utilize this tool to help you understand the potential rewards and risks of each strategy before you go ahead and click on trade to enter this trade into your broker's platform. So with that, that's just a very quick overview of number one, the 2 top strategies that you would utilize as a starting point for a beginner for options trading, whether you're speculating by buying calls and puts or generating income by selling covered calls, and how to utilize this tool to get yourself started with exploring and learning about options. Like I said, learning how to trade options usually for most beginners takes a few months of time, and it takes time to view the webinars that we do. Take some time to explore the platform like this one to help you get familiar and get comfortable, and maybe even do a few practice trades before you're ready to start trading your real account. And this whole process that we have here is really designed to walk you through as much of that as possible. And like I said, the Montreal Exchange not only provides you with educational content like these bi-weekly webinars, which again is designed to provide continuing education, but also access to this platform so that you can utilize this tool to help you do your exploration and trading. So with that, what I want to do is I want to thank everyone for taking the time out here this afternoon. What I want to do at this point is I want to open this up for Q&A and answer as many questions as I have time for. I see there are quite a few questions already that you guys have posted into the chat window. So please type them into the chat window and I will answer as many questions as I have time for here. And I really hope that this was helpful for those of you that are starting out and better understanding how you can utilize options and what tools you have to help you learn and explore options. So please, again, if you want to ask any questions, use the chat or the Q&A window at the Q&A button at the bottom of your screen, and you can ask any questions, and I'll answer as many as I have time for here. So a question here, is the last the bid or the ask? So the last is neither the bid or the ask. The bid or the ask is what the current quote is. The last is what was the last price something was traded at. So the last price could have been traded 5 minutes ago, and the bid ask tells you what the current price is. So that's the difference between the last price and the current bid ask. So bid ask is always the current price, and last price is when it was last traded, whether that was a second ago or 5 minutes ago or maybe even 5 days ago. So last price could be quite old. So what you really want to look at is the bid ask price. Gene is saying not trading but page equals confusing. If I'm not sure what you mean by that, Gene, if you can clarify, I'm happy to answer that. Unless you meant the option chains. If you meant the option chains are confusing, I completely agree. Azim is saying, those that said you don't use that options grid, what do you use besides options play, of course? I'm presuming that if you're not using a page like this, you would have to use a screen like options play, because those are really your only two choices. You know, if you don't have options play, you have to use a page like this. There's really nothing else. Noel is asking about the charts. Are we limited to months? There are no indicators per day or week. I'm not sure what you mean by that. If you don't mind clarifying, I'm happy to answer that question. John is saying, where do I find already recorded webinars? I'm a member. Okay, so let me get everyone the YouTube channel. Just so the best way to find us is our YouTube channel, and I will send a link to everyone here in 1 second. Let me just find it. So I'm sending everyone a link in the chat window. That's how you can find our previously recorded webinars for those of you that want to utilize that. So I just sent that in the chat window. Giovanni is asking, what are the 3 circled strategies? Let me get back to you on that, Giovanni. Let me just answer a few other questions that came in before that. I apologize. Or Giovanni, you actually asked first, what broker platform can you identify without necessarily recommending to trade options? So for the Canadian markets, you know, I think one of the things that I hear the most from users is really sensitivity to commissions, because commissions in Canada tend to be higher than in the US. So it really depends on the size that you trade, because if you're trading small size, you know, brokers that are favorable for that are brokers like Interactive Brokers, which doesn't charge you per ticket and only charges you per contract. You know, for those of you that trade large size, you know, some of the brokers like Questrade provide slightly lower commissions. This is not by any means a recommendation for any of these brokers, but I'm just giving you the feedback that I'm hearing from a lot of users. Bradley is saying, options play is showing BMO is bearish, but if someone intended on holding the stock for 10 plus years, I doubt BMO would not go up in the long run. What is the time frame you're considering? So the time frame is only 1 month and 6 months. So our trend indicators is for short term and long term, which is 1 month and 6 months. So if you're long term, you can completely ignore our trend indicators that have nothing to do with you. So if you're a long term investor and you're buying that stock, I recommend that you sell cover calls against that stock as a way to generate income. So in the short run, as BMO stock may be declining, you can generate some income off of that stock. That's your best use of options if you're a long-term investor. Mark is saying, what is the meaning of the options play score? Great question. And I think that was the same question that Giovanni was asking. So let's cover that. So the options play score is really looking at the risk to reward ratio of each strategy. So as you can see, each strategy has some green, which is the potential reward, and it has some red, which is potential risk. Now, most strategies will express something that looks like this. Now, a put option will tell you the max reward is $9,700. which in my opinion is really unrealistic and not accurate at all, because that requires the stock to go to zero in the next 38 days for you to realize $9,700 in max reward while risking $207. So even though the risk reward on this trade looks really good on paper, it's not realistic at all. So what's more realistic is expecting that BMO is going to trade within an expected range. So for the July 19th expiration, we really expect BMO to roughly be between 95 and 104. And that's really where this green and red comes from. So what we're calculating is the risk reward between 95 and 104, and we're recalculating the risk reward ratio based on the expected trading range. And that's what the options play score is. So for any strategy that you type in, it'll instantly recalculate the score for you based on the expected trading range and give you an actual risk reward ratio that you can look at, and it's normalized for you and color coded so that you don't have to necessarily remember or memorize anything. You just have to know that green scores mean good risk reward ratio, yellow means average, and red means poor risk reward ratio. So if you're looking at something like this where you have pretty much all red and no green, as you can see, very low risk reward ratio, meaning even if the stock goes all the way down to $95 here, you're not really going to make any money on this trade. So that's why it's got a really poor options play score. So that's what the scores in the circle numbers mean. And I hope that answers your question, Giovanni. How do you interpret those red-green little charts? I think you're referring to this red and green stuff at the bottom, or are you referring to the red and green charts here on the left-hand side? If you can clarify for that for me, JM, that I'd be happy to answer that. Let's see. Cover calls. How far out of the money on average? Great question, Gene. So what we typically start off with is you have income settings for your income. And what we usually start off is optimal. Optimal is usually based on, we always calculate our strike prices based on probability. So we usually start off around 80% probability of that call expiring worthless is a starting point. So if you're familiar with delta, we usually start off about a 20 delta. That's how far out of the money we usually choose on a cover call as a starting point. Where do we find pre-recorded webinars? I just sent the link to everyone in the chat window for you to access the chat window. I'm sorry, the previously recorded webinars. I highly recommend you to take a look at this. Ash is saying, is open interest important? I find open interest is not important at all, because look at this chain, right? So you've got a bunch of, let's take a look at this. Let's just look at the July expirations, which spans from here to here. And that goes from strike prices all the way from $68 all the way up to $125. And if we look at the open interest, notice how it pools around these, I would say even numbers, 100, 102, 105, 107, 110, if you will. And notice how there's such a large difference between the 105s, 103s, but not a lot of people trading 104s. So notice how open interest means very little in terms of liquidity, because BMO is just as liquid regardless of which strike that you choose. So open interest is really not that important, at least not on a specific option series and itself. As long as there's open interest across the whole board, you're good to go. If you look at some smaller type stocks, you might find that open interest is far lower. So as you can see, open interest on this stock, well, also is not that bad. Let me see if I can find one with a lower open interest. Maybe this one. So as you can see, as long as there's open interest across the whole strike, then you're okay with most options. It's if you see zero open interest across the whole option chain, that's when you may want to reconsider, meaning the liquidity is probably low. Abraham, is TXS does not have enough open interest and volume to trade, hence premium is very low. So premium has nothing to do with open interest or volume at all. Premium just has to do with the volatility of the options. So I wouldn't discount TSX stocks just because of low open interest and volume. Low open interest and volume just is the factor of the market size. premium is a factor of the volatility of the stock. So especially in the dually listed stuff, the volatility is exactly the same. So you actually have the same amount of premium in U.S. listed options as you do in Canadian-based options. So that's my thought on that. How do you cancel a trade? I'm not sure what you mean by cancel a trade. You can't exactly just cancel a trade that's already been executed. If you just have an order that you can cancel that, and you can just call your broker to ask them how you can do that. Claude is asking, am I right to think that if you have just 100 shares of BCE, the commissions would eat up your premium on a covered call? Let's take a look at BCE. If it's a low price stock, I would agree. So BCE is at $62, not a poor cover call. But as you can see, BCE is obviously not a very a volatile stock. So as you can see, the August 63 cover calls only collects $37 in commissions. So if you're paying $10 in commissions on this trade, you're basically eating away $10 of that. So you're only collecting $27 in income. So yes, Claude, I would agree with you on this specific stock that commissions would eat away a lot of your premium. So it would certainly be difficult to trade this. In some other stocks like BMO, you're going to find a little bit more volatility. You're going to collect a little bit more premium. So yes, I would agree with you on that. Mark is saying on the TELUS example, 82, 86, 102 scores means options play would recommend the put vertical, or we're talking about bearish. So yes, we would always recommend the put vertical. So as you learn more about options trading, you'll really see the benefits of trading vertical spreads. And we're very, very big fans of trading vertical spreads because it really reduces your overall risk, which in turn will increase your overall return. And that's really the best way of increasing returns is really reducing risk. And the more you can reduce your risk, the more likely you're going to increase your returns. So vertical spreads really allow you to maximize your directional exposure while minimizing your risk. So yes, if you want to learn more about that, I highly recommend you to take a look at our YouTube channel and learn more about trading debit vertical spreads and credit vertical spreads for those of you that are a bit more advanced. Claude, thank you so much. I really appreciate it. Stephen Ash is asking the same thing about the options play score. I hope I explained that to you. Can you see American options on options play? I think Barbara asked this. Yes, we have options play for US. So for those of you that are interested in trading US listed securities, you can go to optionsplay.com. You can sign up for a free trial to options play for US options. However, just keep in mind that that is a 30-day free trial, and there's a cost to that. Versus on the options play side in Canada, it is a free platform for you brought to you by the Montreal Exchange. Giovanni, thank you so much. I really appreciate that. JM, I meant on the right. So if you're talking about the green and red charts on the right-hand side, the red just means potential risk and green means potential reward. So if the stock moves lower, that's to the left. If the stock moves higher, that's to the right. So obviously put strategies or short strategies will make money as the stock moves lower, and bullish strategies will make money as the stock goes higher. Giovanni's asking, do we really need to own the stocks for a cover call, or is there a method to take that trade without actually holding them? To sell a cover call, you absolutely need to own the stock. There are strategies that will allow you to generate income without selling the stock, but that's a more advanced strategy that's selling a credit spread. So if you're a beginner, I recommend that you don't move on to there just yet. You take the time to learn about cover calls before you graduate into selling credit spreads. But there are more advanced strategies to generate income that do not involve owning the stock. Jeff is saying sell to close. Not sure if that's to answer the question about canceling a trade. I think that's what you meant. So Nicole, regarding your question about canceling a trade, if you can just clarify on that, I'm happy to answer that question for you. Abraham, how do I access this platform free? Is it possible to use this platform for advanced strategies? So first of all, let me just answer that question on how to access this platform for free. You can access it using this link here. So for those of you that want to access this free platform, just go to the link that I just sent in the chat window. And yes, you absolutely can use this for more advanced strategies. So you can click on modify for any of these strategies. We have a strategy constructor. So if you want to look at condors, butterflies, straddles, strangles, all types of strategies are available here. So you can just, by the click of a mouse, select one. You can move things around. You can make things wider or narrower just by the click of a mouse, accessing all advanced strategies. Bradley saying, you mentioned to be careful during earnings, but earnings can help or hurt. So you can elaborate why you seem conservative with options during earnings. Absolutely. So this is purely based on back testing that we've done as to selling these types of strategies going into earnings versus avoiding them going into earnings. And it is very clear from our back testing that you get higher returns on option selling strategies when you avoid them going into earnings. It's as simple as that. I wish I had a more in-depth explanation for you in that, but I really don't. It's simply based on our back tests. We tried it during all different scenarios, and when we removed them during earnings, our performance went higher. Giovanni, you're very welcome. I really hope that that was helpful for you. Nicole is saying, yes, what do you mean by holding onto the trade until expiration is a bad strategy, is a common mistake? So, Nicole, if you were to buy this call option, let's say you're bullish on TELUS and you buy the July 19th 50 cover calls. So what I mean by that is, let's say the stock is just trading at about $50 right now. Let's say the stock rallies up to $52. And let's say it rallies up to $52 by the end of June. As you can see, if you had bought this call option, which cost you $73, you make a $123 profit, which is a 169% return. So let's say this stock does exactly what you expect it to. By the end of June, the stock rallies up to $52, or let's just say 51.5, right? Let's say a slightly more conservative target price. Let's say this stock rallies back up to about 51.5, makes a new 52-week high in the next couple of weeks, which I think is a reasonable target because the stock makes these $2, $3 swings quite frequently in a relatively short period of time. So let's say $50 is a bit of a low here and it swings back up to about 51.5. Let's say it does that by the end of June. As you can see here, I have a $77 profit on a $73 investment. So that's what happens if it does that by the end of June. Notice if I just hang on to this, instead of selling this at a $77 profit at the end of June, let's say I continue hanging on to this. Notice this option starts to decay. My profit starts to evaporate. So I start to lose more and more money as the stock goes closer and closer to expiration. And this is really why you don't necessarily want to hang on to this trade all the way through expiration, because it will actually erode in value. And you want to make sure that you understand how much it erodes in value as you approach expiration. So this is really what I mean by taking, if the stock makes the move that you expect it to, take that profit, keep that profit. Don't hold it all the way to expiration, because it's going to erode in value and you're going to lose some money to holding it all the way to expiration. Bradley, you're very welcome. Julie saying, on cover calls, are you limited to buying only as many as you own, or can you buy fewer than you own as long as it's more than 100? So, Julie, I think what you mean is selling, but yes, you can sell fewer than you own. You just can't sell more than what you own. So you can sell them in 100 share increments. So let's say you own 500 shares. You could sell just one contract. You don't have to sell 5 contracts. So you can be very tactical on this. You don't have to, you just can't go above the 5 contracts if you only have 500 shares. Giovanni saying, we were recently, yes, I was in Montreal for the seminar. I was unfortunately unable to attend. Are the presentations available? So yes, if you go to our YouTube channel, the presentation that I made is available. I plan on sending an email by tomorrow for those of you that missed Options Education Day in Montreal. We do have Toronto coming up in September, Vancouver, and Calgary, but I will send out an email tomorrow to everyone. If you missed us in Montreal, to be able to see some of the presentations I made, and as well as how to sign up for the next Options Education Days. Daniel saying, is the platform available through TMX or BMO, as I am on point to set up with InvestorLine right now? So this platform is available regardless of anywhere you trade. So you just have to go to this link that I just sent in the chat window. You don't have to have an account anywhere. You just have to go to that link and you can sign up for this free account. Can you lose money by selling covered calls? Technically, you cannot lose money from selling covered calls, because the reason it's called a cover call is because it's covered. Now, the downside to selling covered calls is you can lose out on opportunity. What I mean by this is, let's say you own Theta stock and you sell the 51 cover calls, and let's say the stock rallies up to $60. When you sell a cover call, you're giving up any gains above $51. So even the stock goes all the way up to $60, you're not going to make any more money above 51. So you're losing out on $9 of potential gains, but you're not losing any money. So keep in mind that we call cover calls a quote-unquote riskless strategy, because you can't lose more money than you already have at risk with the stock. So if, let's say you own BMO stock at $90, that means you're risking $90 per share. When you sell a cover call, you can only lose less than $90 a share. You can't lose more than $90 a share. So I hope that clarifies that for you. Ash, does Options Play ever recommend European-style options? So Options Play only shows you options that are available. So the TSX, or the Montreal Exchange, lists the options. They choose whether an option is European or American style. So for Canadian options, all equity options are American style. All index options are European style. So we don't get to choose that. The exchanges do. However, it doesn't really matter for you trading them, because you always sell them before expiration date. So European or American refers to exercise, but really it doesn't ever make sense to exercise a call or put early. So from your trading perspective, it really doesn't matter whether it's European or American. You can buy and sell them anytime you want. So I hope that clarifies that for you, Ash. Giovanni, what about the different speakers that made a presentation in Montreal? Can we have their presentations as well? So Giovanni, I don't know what those presenters spoke about and whether or not they're able to make their presentations available to you. I can only send you my presentations, unfortunately, so I can't answer that question for you, unfortunately. Can you sell Julie's asking, can you sell the stock when you have cover calls that have not expired? So Julie, you cannot sell a cover call you cannot sell your stock if you have a cover call. If you need to sell the stock, then you also need to buy back that call. So you can do that. So if you decide that in the middle of a cover call that you just want to get out of that stock, you sell the stock, but you also just at the same time buy back the calls that you've sold. Looks like I've reached the end of the questions here. Are there any last questions before I sign off for today? Giovanni, I really appreciate the kind words. I really hope that these presentations are helpful for those of you that are starting out and learning, and even for those of you that are experienced. I hope that this gives you some insight, number one, as to how to use our platform, gives you some insight into how options can be utilized for your portfolio. It's not for everyone, but there are use cases for many different portfolios out there, whether you're speculating or trying to generate income. So I hope that this was really helpful for those of you. And again, this is not something that you'll be able to just learn from watching a single webinar. So that's why we make these presentations available afterwards along with the slides, and that you can review them at any time. And we come back every 2 weeks to provide you with new topics and new insight into options trading. And I really hope that you guys find this useful, and thank you so much for all the kind words, everyone. So I will be back, I believe, no, I'm sorry. I think the next one is July 2nd. I think we have an extra week between now and the next one. So I hope that everyone has found this useful. I will send everyone the recording about half an hour, and I'll see you guys in early July for the next one. Have a great evening, and I will see you in July.